All right, guys, let's go ahead and get started. So if you haven't logged in, please hurry and do so. All right, so just a quick heads up before we get started. This is all when you come in every single day, you can just kind of review your notes from last time, right? Or you can pull up the slides that I posted from last time. So the last question, I think, might be a little challenging. Somebody just point out what we talked about. We talked about adjusting entries. We make adjusting entries, usually not because we made a mistake somewhere. It's usually because time has passed, right? So just because of the passage of time, for example, if we've got some prepaid rent, what's going to happen over time? We've paid for the right to have our business there, right? But as time passes, that's going to get used up. And so because time has passed, we have to make what? An adjusting entry. All right, here we go. Question number 1. Cost of goods sold is by far my largest expense in 2018. Cost of goods sold is $66.5 billion. Come on back. There we go. 66.5 billion was 66% of my sales and of 100.9 billion. Who am I? Am I Google, Home Depot, American Express, or Walt Disney? Who has a lot of inventory that they sell? So they have a lot of cost of goods sold. All right, so that is Home Depot. Next question, number 2. True or false? Adjusting entries will always affect one balance sheet account and one income statement account. True or false? All right, that is true. It will always affect one income statement account and one balance sheet account. And which balance sheet account will never be part of an adjusting entry? Cash. Cash will never be part of an adjusting entry. We'll review that in a few minutes. True or false? Revenues should always be recorded when the cash is received. Should revenues always be recorded when the cash is received? Is that true or false? Okay, so sometimes and frequently the timing is different, right? A lot of times you'll earn the revenue and record the revenue now and they'll pay you later. Sometimes they'll pay you up front and you'll actually earn it later. So the timing is often different, which is why we have to make accruals and deferrals. Question number 4, journal entries that bring things up to date due to the passage of time are called changing entries, error correction entries, adjusting entries, or transaction entries. What do you call those things? All right, so those are called adjusting entries. Last one. What is unearned revenue? Unearned revenue. Is it cash that's received, but work hasn't been done to earn the revenue? Or is this a situation where the customer has not paid for a service that has been rendered? Or is it cash was received for a previously performed service? Or is it cash was not received and revenue has not been earned? What do you call unearned revenue? Sorry, this one's probably way too much time. You should not be talking, though, even if you've answered. All right, so unearned revenue is when you receive the cash up front, you haven't done the work yet, and so you have an obligation to provide a service or provide products for somebody. So that's what we call unearned revenue. All right, before we get started, I want to just look at the last slide first. Well, I still have your attention. All right, so last Thursday you turned in part A of the group project. You are not sitting with your same groups today, right? Obviously, but hopefully you know each other, you've met together, you've become good friends. So part B of that first group project is due this Thursday, January 31st, also at midnight. So just a couple of things about that. So I posted, or my TA posted, a solution to part A. So part A, you're just doing the transaction analysis and you prepare financial statements. So you can look through that solution and you'll know exactly what accounts were affected, etc. So some of you have started working on it. Make sure you look at this to make sure your answer was right, because part B, you're going to be graded assuming you knew what the right answers were, right? So all you're going to be doing is recording those entries now as journal entries, posting them over to the T accounts that are kind of representing the ledger, and then again, you'll prepare financial statements, right? So if you did everything right the first time, hopefully you end up with the exact same financial statements the second time. The only thing different is you've gone from sort of this basic transaction analysis format to the actual debits and credits. The other thing I want to point out, first of all, thanks for all being here. Stay with me. You can't skip this class and stay up with it. We're going to be going to what I think is the most difficult part of the first midterm, the statement of cash flows. We've already learned about the income statement. We've learned about the statement of retained earnings. We've learned about the balance sheet. Now we're going to focus on the statement of cash flows over the next week or so. So it's really important you stay up with me. Notice it's in chapter 12. So I had a bunch of people contacting me because they had done the wrong homework or found the wrong homework this time. The homework is always listed. If you look on the syllabus, whatever chapter you're reading, if you go to that chapter in MBC, scroll down to the bottom, that's where you'll find the homework and RA quizzes. So RA 4 and homework number 4 are not in chapter 4. They're in chapter what? Chapter 12. So make sure you go to the right place for that. All right, and again, part B of the project is due this Thursday. All right, so let's go ahead and get started. All right, so here's kind of the agenda for the day. And we're going to spend some time reviewing and really making sure we understand adjusting entries, which was the big topic for today. And then we're going to shift gears and we're going to have what I hope will be a very interesting discussion. We've got a lot of mini cases if you look on your handout for today. And we're going to talk about the ethics of earnings management. Because you're going to find out as we go through this class, sometimes the rules are pretty clear on how you should do things. And a lot of times there's a lot of flexibility in how you should record transactions. And so we're going to talk about the flexibility that managers have and how they should use that flexibility appropriately. All right, so that's kind of the objective for most of the day. So let's start off talking about adjusting entries. As we mentioned last time, there are two types of adjusting entries. We have what are called deferrals and accruals, okay? So deferrals, this is when the cash happens before the income statement recording takes place. Okay, so you're going to receive cash in advance for, like we talked about, unearned revenue, or you're going to pay cash in advance like you do with prepaid rent or prepaid insurance. We also have what are called accruals. This is where the income statement effect happens now, and the cash is going to happen sometime in the future. Right? You've performed a service, you've earned the revenue, but they're not going to pay you till later. Right? Or you've incurred an expense, you were running your machines until you used up lots of electricity, so you've incurred a utilities expense, but you're not going to pay it till later. Right? So those are the two types of adjusting entries. We make adjusting entries because of deferrals or accruals. So let's quickly review the rules that go with adjusting entries. So we talked about both revenues and expenses last time. There were two important characteristics of adjusting entries. We kind of talked about them on the quiz. So adjusting entries never involve cash, right? And adjusting entries always involve at least one income statement account and at least one balance sheet account. So on the revenue side, we have accruals here, right? So look at these two journal entries. Which one can absolutely not be the adjusting entry? It can't be this one because it's got cash in it, right? Does this one up here have one balance sheet account and one income statement account? Okay, so that is the adjusting entry. Down here on the deferral side, which one of these two entries cannot be the adjusting entry? Can't be this one because it's got cash in it, right? Does the other one have one income statement account and one balance sheet account? Yep. Okay, so that's the adjusting entry. All right, those are the hallmarks of adjusting entries. Over on the expense side, same thing, right? Same rules apply. So on the accrual side, which one of these entries cannot be the adjusting entry? Can't be this one because it's got cash, so this has to be the adjusting entry. On the deferral side, where the cash happens first, which one of the entries is not the adjusting entry? It can't be the first one because it involves cash, right? The adjusting entry comes later once that prepaid rent or prepaid insurance is used up. All right, so those are the hallmarks of adjusting entries. Now, this is the exercise we did right at the end of class on Thursday. You remember we went through every single one of those transactions. I reminded you of those rules. Adjusting entries never involve cash, and they always involve one income statement account, one balance sheet account. And I did lots of T accounts to help you kind of visualize what's happening in the transaction. So I want to really encourage you to use T accounts. I'm not going to review the T accounts now. Those are just the transactions. If you go back to your notes from last time, we went through every one of these. And so just looking at the solutions, what can you tell me about every one of these adjusting entries? Do you see any cash on this whole page? Okay, cash is never involved in any one of those entries. And if you look at each one individually, it always involves an income statement account, like maintenance expense, and a balance sheet account, prepaid maintenance, right? So again, this is a great problem to go back and review as you're trying to make sure you have a good grasp of adjusting entries. All right, so our homework for today. I want to review the homework. We had 3 problems. I'm not going to be able to go through every single transaction with you, but I'm going to talk about some of the big picture things that you need to remember. All right, first one, 3-7A, had a whole series of transactions where you had to record an adjusting entry, right? So the first few of them are deferrals, meaning what? Deferral means the cash happens first and you defer the income statement account effect, right? So in the number 1, it says on September 1st, the company entered into a prepaid equipment maintenance contract. So Birch paid $2,700 to cover maintenance over the next 6 months. Right? So this is December 1st. So December is going to now go by. When we get to the end of December, we're going to prepare our balance sheet for the year. Do we have to make an adjustment to that prepaid maintenance expense? Because originally we recorded prepaid. So if you think, what was the original entry? I paid cash to the company. So credit cash. And I recorded an increase to what? Prepaid maintenance expense, right? So this is an asset. So prepaid maintenance, $2,700. Well, is it still true on December 31st that I have an asset worth $2,700? No. What happened to that asset? 1/6 of it was used up, right? 1 month passed, and so now I've used up a part of that. So I need to make an adjusting entry. So if I take, so here's my original entry, right? Credit cash, debit, prepaid maintenance. I need to make an adjustment then, decreasing this account down to what its correct balance should be on December 31st, right? How much of an adjustment do I need to make? $2,700 divided by 6, right? So it's $450 per month that I'm paying these guys to maintain my equipment. So I need to make a reduction in the prepaid maintenance account. Credit, $450. What happens when an asset is used up? Becomes an expense, right? What kind of expense would I call this? Maintenance expense, right? So my journal entry would look like this. So I debit maintenance expense and decrease prepaid maintenance. Okay, T accounts helped me to visualize it. I encourage you to do the same thing. All right. Number 2, supplies on hand at the end of the month. So it's implied what happened. We went out and bought a bunch of supplies. And so the original entry would have been what? I'm decreasing cash, so credit, increasing supplies, debit. And now I get to the end of the month and I don't have $8,400 left. I have to make an adjustment. What do I have left? $3,200. So here's a good time to use a T account. So my original entry was to purchase these things. So I recorded a debit to supplies. Here's the balance I would like to show as of the end of the month, right? So my adjustment is going to be $8,400 minus X to get to $3,200. That amount is going to be $5,200. So I'm going to show a decrease to supplies, right? Remember, as an asset is used up, it becomes an expense. What kind of expense? Supplies expense, right? So that's my journal entry to record the adjustment. All right, number 3. Unearned commission fees. So unearned commission fees, what are these again? It's a deferral. It's a situation where somebody pays me cash. They want me to do some work for them, but I've not yet done the work, right? So when I originally received the cash goes up. That's going to be a debit. I'm going to record a credit to unearned commission fees. Any kind of unearned revenue is a what kind of an account? Liability. I owe somebody some services, right? They gave me the cash. Now I owe them a service. So this is a liability account. Okay, so they're telling me at the end of the month, I've done some of the work. So the amount that I still owe them is $4,000. So think about it. My original entry was increase cash debit, increase unearned commission fees credit. Now I want to adjust the balance from $8,500 down to the new amount, right? I only owe them $4,000 of services now. So how much is the adjustment? $8,500 minus X equals $4,000. How much is it? Hey, you guys can figure that out in your heads, right? So $4,500. So the adjusting entry then will be a decrease to unearned commission fees and a credit to commission fees earned, right? Just a revenue account. All right, so those are 3 examples of deferrals. By the way, let me point out a couple of things while we're here. This next one's kind of tricky. I don't think I could have even conceived of a problem quite like this, but it's kind of interesting. So it says we've earned commission fees during the year, $84,000. We just showed an adjustment here saying some of that unearned commission fees was earned. So far we've got $8,400 plus $4,500 total, right? So the next one says we have some commission fees earned but not yet billed at the end of the month, $2,800. So we did some work for some people, but we didn't bill them yet, right? Have we done our part? We've done the work, so we've earned the revenue, but it's not going to be received until some future period, right? So this is an example of an accrual. We have to go ahead and record the income statement effect, even though the cash is going to happen sometime down the road. Okay, so we're simply going to record a debit to fees receivable, kind of like accounts receivable, and a credit to commission fees earned, $2,800. Okay, now, in your heads here, how much revenue have we earned so far? $84,000 during the year. Last example, the last problem, we earned an adjustment of $4,500, and now we've earned an additional $2,800, right? Okay, so let's roll this into the last one. The last one says Birch Company's lease. So the people who own the building, they set up a special deal with us. They're basically going to share some of our revenues with us. So the lease calls for rent of $900 per month, payable on the first day of every month, plus an annual amount equal to 1% of annual commissions earned. So we have to, end of the year, we got to make this payment to them for 1% of our total revenues, right? And it says this amount is payable on January 10th. So we have to pay it today, December 31st? No, we don't have to pay it today, but we owe it to them, right? So we're going to have to accrue, record an accrual to show that we've incurred this basically extra rent expense. Right, so think about the total. We earned $8,400 plus $4,500 plus $2,800. Total revenues this year, total commissions earned, is $91,300. How much do we owe of that to our landlord? 1%, right? So 1% of $91,300 is basically $913. And what is it? Well, just an add-on to our rent, right? So we're going to call it rent expense, which would be a debit. Have we paid the cash yet? So the credit can't be cash. What does the credit have to be? It's something I still owe, so it's going to be a liability. What kind of liability? Rent. It's rent payable, right? It's additional rent that I have to owe these folks. So that would be the adjusting entry. That's a super hard one. I probably wouldn't give you something that hard on the exam, but it is kind of an interesting idea, something that could actually happen in practice. All right, so that was it for that problem. This next, so adjusting entries, important. You got to practice those. So please go back to the exercise we did last time at the end of class. And of course, this problem will be good practice as well. The next one, 13B, this is like a perfect model for part B of your group assignment. So part A, you just went through and analyzed the transactions and recorded transaction analysis, right? We've posted the solution for that. So even if you missed a point or two here or there, you now have the answer. And so this problem is a great practice problem. You might want to sit down and look through it with your groups before you do part B of the project, right? So essentially, you're going to go through a whole list of transactions. They've got 18. How many did you have in your group project? 20. So pretty similar, right? So you have to go through each of these transactions, analyze them. What accounts are affected? Are they increasing or decreasing? What's the amount? And then translate that to debits and credits, right? Remember the teeter-totter diagram? So if you take those transactions, convert them into journal entries, that's basically what this does. So I'll post these solutions for you, kind of look through it, make sure you feel comfortable with it. Once you've recorded all the journal entries for all 18 transactions, then you're going to post these over or copy them over to the ledger or the T accounts. So you've got a series of T accounts. Cash is the one that's affected the most, but lots of other T accounts. So this is exactly what you're doing for your group project. Once you've recorded all of those transactions, posted them to the ledger, then you prepare a trial balance, right? And those will be your ending balances. Okay, so your trial balance here, obviously you get to the bottom, and if your debits equal your credits, you have some confidence that hopefully you did everything right. Okay, so any questions about this? So the next step that you're going to keep doing, though, you're not going to end with the trial balance. You're going to keep going and prepare the financial statements. So from the trial balance, these accounts here at the bottom, starting with advertising revenue, want ad revenue, and a bunch of expenses, that makes up what financial statement? What do we need those accounts for? Those go on the income statement, right? And then the accounts at the top, what are those for? Those are going to go on the balance sheet, right? Now, there's one other account that we don't show in this problem that would not go on the balance sheet or the income statement. Which one is that? Dividends. Where does dividends go? Statement of retained earnings, right? Okay. So very good. This is a good practice problem, again, to get you ready for the exam. Here's the income statement and the balance sheet. Any questions? You guys are pros. Guys, let me just say this. We're only about 2 weeks away. In fact, 2 weeks from last night is the first midterm. So don't wait until the night before the exam to study. You've got to start preparing in advance, right? So everything we've covered so far, analyzing transactions, preparing trial balances, preparing financial statements, that's a big part of the exam. So start practicing that now. The last thing I told you that we have left is what? Statement of cash flows. And that's going to take some time and effort. So you want to focus on this. That's why I make you do this group project, is to force you to really understand transaction analysis, recording journal entries, etc. All right, the last problem here is what we call closing entries, and I want to really solidify this particular concept with you. All right, closing entries, we do these at the very end of the period. It's the last thing we do. We're going to basically close out what we call the temporary accounts, right? So which ones are the temporary accounts? Come on, guys, you know this. All of the income statement accounts are temporary, right? We want to calculate net income for the year 2018. As we roll into 2019, what would we like to do? Start fresh with zero balances so we can calculate net income for the new period, right? So closing entries we always have to do at the end of each period. All right, so we're going to close out all of the income statement accounts, and there's one more temporary account we have to close out. Dividends, right? Because we want to know how much we paid in dividends last period. Start fresh so we can calculate how much we paid in dividends for this period. All right, so this, let me say two things. You were assigned problem 9A. This is 19A. So I want you to actually go back and look at both of them. So 9A had you close your temporary accounts out directly to retained earnings. And that's how we do it sometimes. Problem 19A says to close them out to another temporary account called income summary. So you close out your revenues to income summary, close out your expenses to income summary. If you put all your revenues and expenses in one account, what's the balance in that account? Net income, right? You're basically using that account to calculate net income. Once you calculate net income, then you close that account out to retained earnings. So it adds kind of an extra step along the way. So I'm actually showing you problem 19A, so you can kind of see it that way. And it also forces you to do the journal entries and kind of see the T accounts at the end. All right, so if you look on your trial balance, you've got revenue accounts and expense accounts, right? All of these are temporary accounts, need to be closed out. We also have dividends up here that needs to be closed out. So if I were doing these, the order I would start first with my revenues. So I have two revenue accounts. What kind of a balance do they have? Is this a debit or a credit? Right side is credit, right? So if they have a credit balance, how are we going to zero them out and make them zero again? We're going to make a debit to those accounts to close them out, right? So if you drew some T accounts, you could actually visualize it. So we're going to make a debit to each of my revenue accounts, my income revenue accounts, and we're going to credit them or close them out into income summary. Okay, so what's my next set of accounts? I've already taken care of the revenue accounts. What do I have next? Expense accounts, right? So my expense accounts, let me go back. Expense accounts have what kind of a balance? They have a debit balance. How do I zero them out? I'm going to make a credit to each one of those accounts, right? That will zero them out. So make a credit to those accounts, and I'm closing them out with a debit into income summary. So credit each one of these accounts, right? So to make these zero, I make a credit to each one of them, and I close out the total into that account called income summary. All right, so now I've got this account that says income summary. What's in the account? All of my revenues are in there, and all of my expenses are in there. So the balance left over in income summary is net income. I'm going to close that. Remember, net income just closed out to retained earnings, right? So if you calculate the difference between those two, so if you calculate your total revenues minus your total expenses, that's the balance left in the account. If it's an income number, it's going to be on the credit side. So we're going to close that out by making a debit. So we'll make a debit to income summary for $32,100 and close it out into retained earnings with a credit. Okay, what's the very last closing entry we have to make? Dividends, right? So dividends has what kind of balance? Debit. So to close that out, we're going to have to make a credit to dividends and close it out with a debit into retained earnings. So there's the journal entry. All right, so what's my balance in retained earnings? If you go back, I had a beginning balance in retained earnings of $14,100. I closed out net income, so beginning balance plus net income minus dividends, right, equals my ending balance in retained earnings. That's the whole purpose of closing entries, right? We're zeroing out all the temporary accounts, and we're updating our retained earnings balance to the actual closing balance that we want to show on our ending balance sheet. All right, guys, these three problems are really critical. You need to go back and practice them. The first entry, it's all about adjusting entries. The second problem is basically a review for your group project that you're turning in. And this third one was how do you do closing entries? Absolutely have to get this down. So if you went through the homework and you missed some stuff here and there, then you want to go back and practice this so that you're going to be ready for the exam. The exam is all about recording transactions, including adjusting entries, including closing entries, and then understanding the big picture of how these all fit into the financial statements. All right, and let me just give you a little warning. The first exam tends to catch people off guard. I posted a practice exam for you. You might want to peek ahead and say, oh, yeah, that's kind of hard. I better start studying now because you want to make sure you're ready for that exam when we get there. All right, guys. So after you do this problem here, what's left after you've closed out all your income statement and dividend accounts? You're just left with a post-closing trial balance that includes only the balance sheet accounts. And you'll notice that our retained earnings account is now updated to the correct ending balance. All right, so we're going to start off now and talk a little bit about earnings management. And so before I get started, I got a little joke for you. All right. So we need a chair here. Once upon a time, there was this business owner, and he decided to hire someone to be the manager of this large division of his company. And so, you know the new interview techniques, I don't know if you guys have heard about this, but sometimes they'll ask you like really off-the-wall questions. And so this guy decides, I'm just going to hold my job interviews. I'm going to ask them one simple question. I'm going to base my decision based on this one question. So first person comes in, sits down, and the manager says, the owner says, all right, here's the question for you. Oh, by the way, this person is a journalist, okay? He says, what's 2 plus 2? The guy goes, 22. He goes, thank you very much. You can step out. So the next person comes walking in, sits down. It's a social worker. He asks the same question. He says, what's 2 plus 2? Social worker says, math wasn't my big thing. That's why I went to social work. But I'm so glad we have the chance to sit down and discuss it. He says, thank you very much. All right, so this person walks out. Next person walks in. It's an engineer. Guy's pretty smart, right? So he says, what's 2 plus 2? Guy reaches in his pocket, whips out his calculator, happens to be a financial calculator. 2 plus 2, says the answer is somewhere between 3.999 and 4.001. Thank you very much, sir. So the guy walks out. Next person walks in, sits down. It's an attorney. He says, what's 2 plus 2? The attorney says, in the case of Jenkins versus the Department of the Treasury, 2 plus 2 was proven to be 4. He said, thank you very much. So the guy walks out. Last guy walks in. It's an accountant. Sits down. He asks the same question. What's 2 plus 2? Gets up. Closes the door. Sits down. Leans forward. What do you want it to be? Guess who got the job, right? Okay. So sometimes accountants... Series off for the day. Sometimes accountants sort of get this reputation that they can cook the books or whatever, right? So what we need to do is spend some time talking right up front in this class about the ethics of earnings management. So why do companies manage earnings? Let's just kind of start off with a big, broad question. Well, there's a lot of reasons. Sometimes people want to make themselves look as good as possible. They're sort of window dressing because something big's about to happen, like an IPO, initial public offering. They're going to offer stock for the first time. Sometimes managers are being compensated based on a bonus kind of plan where they have to meet certain targets. If their earnings meet a certain level, they're going to get a bonus. If they're below that level, they won't get the bonus. So sometimes managers are personally motivated to try to reach certain earnings targets. Sometimes there's external pressure to manage earnings. So a lot of companies, especially public companies, they're going to feel external pressure to meet Wall Street expectations, right? So if analysts are forecasting the company's going to earn $1.50 per share, and if they come in at $1.49, guess what happens? Their stock price gets pummeled, right? Because they didn't meet analysts' expectations. So it's a big deal. It's a big motivating factor for a lot of managers. And sometimes managers, they just want to smooth their earnings and make them look as like they're really in control of this company. So there's a lot of motivations why managers might want to manage what they're reporting to the outside world. So how does a person manage earnings? Well, there's a lot of ways, and we'll spend time talking about this. So sometimes they'll strategically time transactions. So for example, it's December 28th. And we're due to do a bunch of maintenance on our equipment. And we say, you know what? If we have the maintenance people come in and do all the work, we're going to incur this big expense right before the end of the year. We're so close to meeting analyst expectations. Let's just kind of put that off. We'll do it sometime in January. So we're just going to strategically time when we incur the expense, right? So it's just a timing kind of issue. Other times, managers will sort of manipulate estimates they have to make. So a lot of times you don't know the exact number. You have to make estimates. And so they'll estimate high or low because they want to sort of manipulate how that expense is going to show up on their income statement. Sometimes they just out and out commit fraud. So we're going to talk about the ethics of these types of things that take place. So here's a research project that I'm currently working on. Hopefully it will be published soon. But we spent a lot of time thinking about how do companies manage their earnings and what should they be doing ethically. So if you think about what we are learning about now, generally accepted accounting principles, kind of think of it as an oval. So there's some flexibility in some of the estimates we're going to make. As we go through the class, we'll talk about choices that managers have to make, different ways of accounting for inventory, different ways of accounting for your long-term assets, different ways of accounting for accounts receivable. There's some flexibility because you have to make estimates and judgments. You have timing in the way you record your transactions when you actually do them. Your credit policies, you have some expenses you can choose to incur or not. You can manipulate your production levels. You can choose different accounting methods. So there's some flexibility in the choices that managers make. So I have a continuum down here. So if you start very conservatively at this side, you're very, very conservative on everything you do. And the more you move this direction, the more aggressive you could be in the choices you make in your accounting assumptions, estimates, and so forth. Well, at some point in time, if you push it and push it and push it and push it, you're going to find yourselves right on the edge of that oval, right? You step 1 inch further, you're breaking the law, you're going to jail. So there are people that actually step out and they actually do things. I'm going to call it manipulation. And it's all about your intent, right? So if you have the intent to mislead people, shareholders, lenders, other stakeholders, you're going to find yourself out here. These are illegal acts that would include fraud, intentional misstatements of your financial reports, or other kinds of activities that are illegal. Right? So all of these things would be considered outside of GAAP, and these are things that would definitely send you to jail. Right? So what happens if these things happen? Well, sometimes they have to restate your financial statements. We'll talk about this later in the class. Huge hit to your stock price. If you have to go back and say, oh, we reported these numbers, but kind of we were wrong. They're actually something different. Restatements, boom, you're going to get hit. You might have SEC enforcements, big fines against the company, right? Or you might actually find that you're being prosecuted and sent to jail. You notice that so it's clear, we know that inside the GAAP oval, this is legal stuff, and out here, this is illegal stuff, right? What about this area right there? How did I characterize the oval on the right? This is where you have an intent, right? You purposefully intend to mislead people, right? Is it possible that you might actually intend to mislead people, but you're going to stay within the rules? Okay, that is a very dangerous area to be in, right? Because you might still technically be following the rules, but you're trying to present a case that's not true. You're trying to help, make people think that your performance is better than it actually is. All right, so we're going to spend a lot of time throughout this course because I know that a lot of you, I'm trying really hard, right? I'm going to try to convince all of you to major in accounting. But if I can't, a lot of you are going to end up being managers, finance people, whatever, and you're going to have to make ethical decisions throughout your career. And so we will talk about, as we go through the class, the discretion that exists within accounting. And you just want to make sure you don't ever find yourself either committing illegal acts, you don't want to go to jail, right? But you also don't want to be using the accounting rules to in any way manipulate people. So that's the ethics that we'll be talking about. All right, so everything hinges on your intent. All right, so a question for you. Should companies manage their earnings? What is the job of managers? Do responsible managers manipulate or manage public perception? And finally, what is the responsibility of financial statement users? So what I'd like you to do is introduce yourself to your new group members and take just a couple of minutes and kind of talk through each of these the big questions, should they manage earnings, and then each of these sub-questions. And we'll talk about it together. Go. All right, guys, let's talk about it together. Should managers manage public perception? Very broadly. Do you have a responsibility to your shareholders? Okay, so yeah, you don't want to make yourself look like an idiot. You don't want to make the company look like it's inept, right? You want to make sure that people trust you as a manager and they trust what the company's trying to accomplish. So yeah, you have to manage public perception. Should you manipulate people, though? Okay, so let's kind of talk through what is the job of a company manager, right? You're hired by a company. They pay you money. What is your job? If it's a public company, who do you represent? You represent the shareholders, right? So if you think about it, you all had econ classes, hopefully. So if you think about it, your job is to maximize shareholder value. You're there representing the shareholders, right? So if you think about it in a company, ultimately the owners of the company are the shareholders. And what do? They're going to hire a board of directors to represent them in making major decisions. The board of directors, they're not going to be in the office every single day, so they're going to go out and hire managers, right? So shareholders elect the board of directors. Board of directors hires a management team to come in and run the day-to-day operations of the business. So that's your job. You're representing, ultimately, the shareholders. And they own the company, so you're trying to maximize their investment in the company, right? Okay. Does that involve doing things that are illegal? No, right? You should be operating within the law. You want to do the best you can for your shareholders, but you want to do so in an ethical and legal way, right? So again, you're representing them, and you need to make sure you're careful about how you do that. So public perception, yeah, that is part of your job. It is something that affects shareholder value. All right. So does a responsible manager, and I'm going to use the word manipulate, or manage public perception? Do you have a problem with the word manipulate? If you remember my very first slide with the two ovals, anytime you're trying to manipulate people, you're essentially trying to mislead them, right? And that's not what you're supposed to do. So yeah, you're responsible. You want to try to manage public perception of how the company's doing, but you don't want to do so in a way that would be considered misleading. So be careful with that. Yes, the financial statements are part of your overall company, public relations. And a good manager is going to focus on good public relations, but you want to make sure you're doing so in an ethical way. All right, so this brings us to, I'll show you this picture in a second. I kind of drew on the board here a timeline, and I've got two companies. So hypothetically, company A and company B. On the y-axis, you've got their earnings per share, and then you've got over time, right? So which company looks more stable, or looks like the managers are more in control? One where you have earnings sort of bouncing all over the place, but kind of in an upward trend, or a company for which earnings appear to be very, very closely tracking a specific trend? Which company looks safer to you as an investor? Company B, right? Which management team, if you're trying to choose, whether you trust the managers, which management team seems to have more control of what's happening in the company? Company B. So that's kind of a general way that we often think about our investments, right? We want to think about hiring managers who can really control what's happening in the company. So the classic example of the kind of the poster child when it comes to earnings management and perception management is a man named Jack Welch. A lot of you probably never heard of Jack Welch. He was one of the most famous CEOs. He was the CEO of GE Corporation, General Electric, from 1981 to 2001. And during his tenure as CEO, GE had this amazing growth. It was steady, and it was constant, and it was upward, and it was very, very clear how the company was doing. So this is earnings from 1981 through 2001 for GE Corporation. Do you see a trend in their earnings? Is it upward or downward? And is it a pretty clear upward trend? So if you look this first part, I can see a pretty clear trajectory. Then what happens at that point? It even picks up from there, right? It's pretty clear what direction GE was going. Now, my father-in-law happened to be in a big part of the management team for GE during those years. And so when I was an accounting student, I said, come on, what's Jack Welch up to? Is he kind of cooking the books? Come on, tell me the story. And he was very adamant. Jack Welch was an amazing motivator. Like the entire organization, from the very lowest employees, like the maintenance people, all the way up to the vice presidents of divisions, everybody knew next quarter, this is our goal. We're all striving to meet that goal. Whatever we have to do, more sales, get out there and sell more, do whatever you have to do because this is our target. Then next quarter, what's our goal going to be? Right? There's this upward trajectory. They're managing. They're doing everything they can to work toward those goals, right? Now, on the one hand, that's kind of the feeling they had in the organization, that we're all working toward one goal. We have this upward trend. At ex post, there was a lot of discussion that went on in those boardrooms. You know, man, let's postpone these expenses. We're going to accelerate. There was a lot of work. They went into managing the timing of transactions, the way they estimated things, right? Because they were trying very, very hard to present this picture to the public. Now, what happened when Jack Welch left as CEO? Next guy that took over, Jeff Immelt, was there from 2001 to 2017. Guess what it looked like? So during that period, do you see the same upward trend? If anything, maybe a little bit of a downward trajectory, right? Now, a lot of people have said, hey, it's not fair to compare because Jack Welch maybe was in more of a period of growth, and maybe Jeff Immelt had, he had some rough times, right, with the financial crisis and other things going on in the world. So you can't necessarily attribute everything that happened to the company to the CEO. But there's definitely a difference in this picture and this picture, and it has a lot to do with the tone at the top of the organization, right? And so you need to think very clearly about what is your job someday when you're running a company. Is your job to manage public perception? Yeah, that's part of it. But what should you be willing to do in order to meet those expectations and public perceptions? So, what is the responsibility of financial statement users? If you're an investor and you invest $1,000 in a company, you're going to get those financial reports every period, right? What should you do as a user of those financial statements? What's your obligation? Yes? Check what? Check the credit. You want to make sure that you've hired a credible management team, right? So if you're investing in a company, you better know what's the culture of that company, what's the culture of the management team. Absolutely. That's your responsibility to kind of check up on that, right? As a shareholder, should you be monitoring what they're doing inside the company? Yeah, that's why you elected a board of directors, right? Their job is to hire auditors to come in and to make sure that they're doing things in an ethical and above board way. So that's part of your responsibility. I think, guys, sometimes we don't think about this, but we have a responsibility as shareholders to be a little bit skeptical, right? We know if we've got a bonus plan in place and we're telling managers, you got to get this much in earnings to meet the bonus plan, guess what managers are going to do? They're going to be twisting all the dials to meet that expectation because they want their bonus at the end of the year. You motivated them to do that, then you need to make sure you understand. You better have some healthy skepticism, right? So financial statement users should be aware of the motivations that are pressuring managers. Are there expectations on Wall Street to meet a certain earnings target? Are there expectations that we've built into our bonus compensation kind of plans, right? Those are things that we should be responsible and sort of have sort of a skeptical view of what's happening with the financial statements. Now, it doesn't mean that we should expect fraud, but we should put every kind of control in place that we can to make sure that managers are operating within the law and within what we consider to be ethical. So I think it's just important to kind of think of that perspective as well. Now, I want to say this, and we're going to talk about ethics on and off throughout the semester. I'm going to teach you about accounting and how it works. I'm going to teach you about the choices you have to make as a manager between accounting methods, when you're making estimates and so forth. I just really want to emphasize the importance of personal ethics. There's this slippery slope. Sometimes, the joke I told at the beginning, what do you want it to be? A lot of times, people put pressure on their accountants to adjust the estimates, to do whatever, because they want to meet a particular target. The top managers are worried about their bonus. They don't really care so much about what happens to that accountant. If you're making those kind of decisions, you don't want to be put in a situation where your ethics are going to be challenged. It's kind of a slippery slope, because if one period you're willing to compromise just a little bit, you're still sort of within the oval, you're right on the edge, you haven't quite stepped over. But the more you get to that edge, the more likely it is you're going to get pushed out. And then you find yourself going to jail. So be very careful throughout your career, right? There's nothing more important than your reputation. There's no job, there's no amount of money that's worth compromising your ethics, because then you find yourself in jail, right? You find yourself with no future, right? Because once you've lost your reputation, you can't get it back. All right, so I just want to make that clear. Now, what we're going to do for the last part of class is look into some real-world cases where companies had to make decisions, ethical decisions. In every one of these cases, you're going to find out, see some examples of where companies actually made the wrong decisions. So what I'd like you to do, we're going to go through each one of these cases, and I want you to talk about them in your groups, and then we'll kind of go over what really happened. So, mini case number 1 is located on the left-hand side of your handout toward the bottom. And so in this case, it says, Barbara Vincent is considering an incentive scheme that would motivate employees to focus more on the company's bottom line results. So she's considering a plan that would give each employee a bonus based on the company's reported net income for the year. Sorry, actually I'm going to give you some ethical situations first, and then we're going to go into some real cases at the end. All right, so quickly read through it, talk about it in your group, and then list and discuss what are the disadvantages of having an earnings-based bonus system. Take about 2 minutes. Go. All right, guys, you are the shareholders. You've elected a board of directors who have hired this management team. Now, you're deciding to put in, potentially, this earnings-based bonus scheme. We've already kind of talked a little bit about this. What are some of the pros and cons of basing their bonus on bottom line earnings? Pros and cons. Any pros? What do you think? Mr. Alex? Yeah, it's going to encourage them to work harder, right? So if we've got a goal, we want to meet earnings of this level, and you say, look, guys, I got a bonus for you if you can meet that target. So everybody's going to be working for that goal, right? If you've got charismatic leaders like Jack Welch, they're going to spur everybody on to try to meet that target, and hopefully they're going to get their bonus, right? So it could be a good thing. It could really spur the company on to actually improve their operations and to really improve what they do, right? Are there any downsides to this potential strategy? Potential downsides.
I feel like employees will get reckless and how they'll try to influence others to make
So if you couldn't hear, she said it might make employees act in a reckless way, right? They might actually try to get other people to kind of work together with them, but they might be encouraged to do some things that are not ethical, right? Somebody else had a comment over here.
It'd be kind of like the Wolf of Wall Street, just money hungry kind of things, just not completely being truthful about what they're selling.
So maybe it's going to encourage people to not be completely truthful, to just be so driven by this objective to meet. Hey, everybody, if you have kids, you want that Christmas bonus so you can have some money at the end of the year, right? So the money might incentivize them to behave in a way that's not completely ethical. Robin?
It's very, very easy, at least in some companies, to lie about what you make. And you just don't get really questioned about it.
So we talked about that border between being within the oval, what's acceptable, and stepping outside of it. So Robin said it's very, very easy to potentially do something that's unethical, right? To do something, to misreport what's happening with your company, right? Brett?
It kind of lengthens the divide between people at lower levels and higher levels, because the lowest level worker could be working the hardest yet still earn the least bonus?
So sometimes, okay, that's a good point. So if you couldn't hear what he said, it might kind of like exasperate these differences between the higher level people and the lower level people. A lot of times there's no bonus for the lower level people. They got the people, the taskmasters with the whip, making them work long hours, but they're just making their $10.50 an hour or whatever their minimum wage job is. And the bonuses are going to the top level managers, right? So that might actually separate them in terms of their incentives, right? So ultimately, the problem with this kind of a bonus plan, it gets people to be very narrow-minded, very short-term focused. If all I care about, I'm in the fourth quarter and all I care about is meeting my earnings target for the year, I might do some really stupid things, right? I might stop doing maintenance on my machinery. What's going to happen eventually if I don't maintain my machinery? It's going to break down. In the long run, it's going to hurt the company. I'm just worried about this short-term goal. If I'm a short-term focused person, I might do some things that are either unethical, or if I start borrowing from the future, making accruals that are not quite right, then I might have a bigger problem meeting expectations in future periods, right? So there are all kinds of negative effects that can come from giving people a short-term focus. So we've talked about the advantages, but there are several disadvantages. It might give them incentives to manipulate less reliable information, and it might give them an incentive to focus on the short term. So we're not going to talk a lot about this, but as a manager, you should, if you're someday a board member or whatever, you want to think about what's the best way to motivate people. You need some balance between short-term and long-term focus. So if you have a bonus in place, you all should have a long-term plan in place. Maybe they're compensated with stock options, right? How do you earn money with stock options? They give them to you sort of out of the money, which suggests that they're not worth anything now, but as the value of the stock goes up, then you can cash them in and make some money, right? So you get them to have a little more of a long-term focus. So having long-term performance plans in place, in addition to some portion, maybe based on short-term bonuses, will give them more of a balanced perspective so they're not so focused on the current period. All right, let's go to the next little mini case. So your next one on your handout, you've got a guy named Chris Titera. He's the CFO of a Dallas company. And they have preliminary results. So they do their closing entries, right? They calculate net income, and it's like, you've got to be kidding me. We had this goal. Analysts had this idea in mind that we're going to meet this certain level. We have come up $100,000 short. Now, to us, $100,000 sounds like huge money, right? Wouldn't you love to have $100,000? Okay, but to these companies, if they're billion-dollar companies, $100,000 is like petty cash. It's like chump change. It means nothing. So for this company, let's assume they have assets of $1 billion. Count the number of zeros. 100,000 is less than 1/10 of 1%. Literally, it's immaterial to the company. It's so small. I mean, they would throw away $100,000 and not notice it at all, right? It's absolutely immaterial to them. So with that size of a company, what things could Chris do as the CFO to turn this very, very small loss into a profit? Because remember, out in the world, $100,000 seems like a lot to us, right? And if you say we reported a net loss of $100,000, we're like, oh, geez, they blew it. Well, to them, that's essentially zero, right? So if it's essentially zero anyway, is there any way they can make up that $100,000 and make it at least positive? Take a couple of minutes and talk about it in your groups. Okay, guys, if you're a billion-dollar company, do you think you could find a way to come up with $100,000 to turn this into a profit? Very easily, all right? Now, after we get past midterm one, we're going to spend some time talking about all kinds of different areas in our financial statements where there's flexibility, where decisions have to be made. What method do you use? How do you make these estimates, right? as we get into the rest of the semester, you're going to see there's tons of flexibility. That's why I showed it as an oval. You can be more conservative or less conservative depending on the choices you make. So it would be very, very easy for a $1 billion company to come up with $100,000. I'm quite certain, back in the days of Jack Welch at GE, they would come up with their preliminary income number, and then they'd all sit in the boardroom and say, okay, now what can we do at the end of the year to make sure we're on target, right? So, for example, when you have to estimate what percentage of your customers won't pay you, you have to record what's called bad debt expense. Those estimates, it's based on past experience, right? There's some flexibility there. When you're depreciating your assets, let's say you bought a machine. Is it going to last 10 years or 20 years? If you divide that cost up over 10 years, it's going to give you one depreciation expense. Or if you divide it over 20 years, it'll give you a different depreciation expense. There's some flexibility there and judgment. You have estimates on warranties. If you sell lots of electronics, some of those people are going to return the products to you for repair or for replacement based on the warranty. Well, how do you know how much to record as your warranty expense? It's an estimate based on past experience. Environmental cleanup. What if you've been dumping waste into a river? You might get fined and have to go back and clean it all up, right? Well, how do you know if you're going to have to do that? Well, it depends on estimates. It depends on the way you've been running the business. There's all kinds of flexibility. A $1 billion company could easily make up that $100,000, which is such a small amount compared to what their actual size of the company is. I just want to say, you got to be very, very careful, because if you're the person making those decisions, what kind of precedents do you want to set? Do you want to become known as that person who's willing to compromise? You got to be very careful, because you don't want to have that reputation of being the flexible guy. Okay? Now, I just want to show you some evidence. So here's from research that there's a professor over in Atlanta in Emory. This is kind of a famous picture. So this shows people's earnings, and you can be right around zero, for example. So what if a company's just a little below zero? They're going to report a net loss. They're going to have that meeting in the boardroom that we just talked about, right? So you notice that if it were a nice normal distribution, it would be centered on zero, right? What do you see just below zero? Like, there's nobody just below zero, but there's all kinds of people just above zero. What happened? They got together and said, oh, let's change our estimates, or let's change the timing of these transactions because we're so close, we just want to make it over the hump to be positive. Do you think there's evidence here in this picture that maybe some companies are managing their earnings? Yeah, it's happening, right? So again, as a shareholder, you need to be a little bit skeptical of those people that are just over the threshold saying, I kind of know what's going on here. And you need to understand that those are the kind of decisions that companies face all the time. All right, we're getting short on time. I'm going to have you talk just for a second about this one. This is an ethical kind of situation. What happened last summer in California? Wildfires, right? Homes are being burned. People were dying. Animals were dying. It was a huge problem. They were calling in firefighters from Georgia. Firefighters from all over the country were heading out to California to try to fight those fires. Well, here's an example. So you've got a company, and they're called Flame Control. They manufacture firefighting equipment. And many large fires this year in the forested areas of the Southwest. And so they're very successful financially, obviously. But there's been some grumbling in the press about, you know what, these guys are gouging people. They're charging really high prices for this equipment, but we need it in California to fight the fires. And so there's political pressure on these guys. So what issues and what accounting actions might you consider as you prepare preliminary financial statements if you're the managers of this company? What do you think the pressures are? Do you want to report a record profit this year? Or would you rather show a lower profit? Take some time and talk about it in your groups and see what you think.
well established and trust. That's hard to
All right, guys. What kind of political pressure do you think this company would face after a record year of terrible wildfires when they're about to report record profits? Do you think you want to be the firefighting equipment company that reports record profits in the year that so many people suffered? No, you do not. This is not the time to try to report record sales, right, and record profits. What might, instead of, we always talk about companies trying to overstate their performance. They're trying to report better than average results. What do you think the pressure might be on this company this year? To report lower profits, right? They don't want to make a big scene. They don't want people to scrutinize them, because what might people do? Tax those guys, right? Give it back to the citizens or whatever. There might be a lot of political pressure against them to try to report a lower income number in this particular year. Okay, so this kind of stuff happens. You might see companies that are actually, hey, let's go ahead and report and record lots of maintenance, and let's go ahead and they're going to do all kinds of real decisions to time things and do things this year to incur expenses so that our income doesn't look quite so high this year. All right, well, so be careful when you think about these situations. You're probably too young to remember this, but when my kids were younger, so they're around 2005, I think was the year, we used to take big road trips in the summer, throw the kids in the van and take a trip, go somewhere on vacation. Well, it turns out that gas prices got so high. It was like $4.50 a gallon, $5 a gallon, depending where you went. I don't know if your parents took road trips. You were probably pretty young then. But your parents maybe didn't choose to go on those road trips because gas was so expensive. Well, it turns out during those years, the big oil companies, ExxonMobil, they say, hey, it's not our fault, it's the OPEC nations. That's right, it's those Middle Eastern companies are charging us more for the crude oil, and so we have to charge you more. So why is it you're reporting record profits in a year that we're suffering? Right? So there were a lot of people writing to their Congress people and saying, hey, we should tax those oil companies and give it back to the citizens or force them to make the prices lower because they're reporting record profits in a year that we can't even travel because gas is so expensive. So political pressure can be a very strong incentive for companies to not manage their earnings upward, but to manage them downward, right? So again, I just want you to be thinking about these kinds of issues that face managers. All right, we're going to talk about one last thing. I got two more stories, and I want to try to get through them before we get to the end of the day today. So the first thing, what is an auditor? So in order to make sure companies are behaving, that they're reporting things fairly, we have to hire what we call auditors to come in and check the company's books out, right? Does anybody here have cousin, brother, sister, aunt, uncle, somebody who's a CPA? Do they do auditing? Okay, that's their job, right? They come in at the end of the year, they check the books, they go through and look at the transactions, they look at the records, they check things out to make sure the companies are not trying to mislead shareholders or mislead the government, right? So companies have to hire these people, these external auditors, to come in, and that's a very critical role in our capital markets, making sure that companies report fairly, right? The SEC, Securities and Exchange Commission, what's their job? We've talked about it before. What is it, guys? What? To do what? Make sure they follow the rules, right? What were you going to say? Regulate what people are doing out there, right? Make sure that they're not misleading. The SEC has the job of protecting the common investor. And so they require companies to hire auditors, external auditors, independent people, come in, check the books at the end of the year, and make a report telling people. Remember we looked at Target's report first day of class? Make a report to people to say, we've checked the records and we don't find anything that would be materially misleading here to shareholders. All right, so auditing is a big part of the accounting profession. It's a big part of what happens in business. All right, what I'm about to share with you, we've got 5 minutes. I'm going to share two stories. These are two of the biggest corporate frauds in history. And so I'm just going to quit. We don't have time to talk about it with our groups. I'm just going to walk you through the stories and tell you about what happened. Now, you've all heard the story of Enron. Some of you weren't born then. It happened in about 2001 is when they kind of went bankrupt. So that's one. I'm going to share you some other stories that maybe are not quite as well known. All right. So the first one, we're just going to call this Barry and his carpet cleaning sales. So this company was based in California. And they would go around and they would do all kinds of cleanup, carpet repair, et cetera, So if you're the auditor and you're concerned that this company might be misleading people, because they were actually doing really, really well. So their sales have been increasing by 200% per year. One of their current jobs is located in a town called Arroyo Grande. The contract is for $2.3 million. It's a restoration job on an 8-story office building. This guy, Barry, is working on a $7 million restoration job in a building up in Sacramento. And they have an $8.2 million restoration job ongoing in San Diego. So does it look like they have enough growth to keep increasing their sales by 200% per year? Maybe. But if you're the auditor, you got to go into this company kind of skeptical, right? Can companies maintain 200% growth year after year after year? Maybe not. Maybe these guys have some incentives to overstate how things are going, right? Well, when the auditors started checking up on this company, all kinds of crazy things happened. So I was going to have you talk about it. I'll just tell you what happened. So they went out and they did some audit work, and here's what they found out. So you want to check out to make sure these are legitimate contracts, that these things are actually happening, right? Well, what did they find? This is actually a famous story. It happened in 1987. This company was one of the fastest growing companies. It turns out Arroyo Grande, there were no buildings more than 3 stories high. They said it was an 8-story building they were restoring. Wasn't happening, right? The Sacramento job was some random office building. They took the auditors into this building and said, yes, we're doing restoration work here in this building. They're just walking through this random building. They went to San Diego, and the job didn't exist. This is what length this company went to. They leased a building, went in and built out all this stuff and pretended to be maintaining it and everything so that they could present they had this $7.3 million job. It was totally fake. Of course, that guy went to jail for a long time. All right. One more. This one's great. So anybody here ever visited New York City? Okay, right across the river, the Hudson River. What on the south side, what do you have? New Jersey, right? So there was this big oil field in New Jersey, near New York City. And this company, they bought this thing. It had a whole petroleum thing. They had all these big tanks for storing petroleum. And these guys bought it, they cleaned out the tanks, and they now use them to store large quantities of vegetable oil for making salad dressing and things like that. They report this vegetable oil inventory has a value of over $300 million in salad oil. Just these huge tanks in New Jersey, right? And so you're the auditor. Do you trust them? Do you believe they really have $300 million of salad oil in those tanks out there? No, probably not, right? 300 million. Well, so if you're the auditor, what do you want to do to make sure that it's legit? You want to see it, right? You're going to go there, you're going to climb up on those big tanks, and you're going to dip something down in there and make sure there's really some salad oil in them? Do you think you might want to do that? Okay. Well, that's the job sometimes. The auditors have to check these things out, right? So I'm not going to have you discuss it. I'll just tell you the story really quickly. So when the auditors went out, they looked at their shipping records to confirm that they'd actually been selling salad oil. And so they went out and actually looked at the inventory. And here's what they found. Most of the vegetable oil, what they had done is they'd pumped seawater in from the ocean, filled up the tanks. And what happens when you put oil on top of water? Floats to the top. So they pumped in some salad oil. So they have, some salad oil floating on the top of seawater. And then, so the auditor goes, he's climbing up the ladder, dipping a thing down. Yep, sure enough, there's salad oil. While he's climbing down the ladder, they turn the pumps on. They're pumping that oil over to the next tank, which is full of seawater. The guy climbs up the ladder, dips down. Oh, sure enough, there's some salad oil in there. And he did this for every one of the tanks, right? It turns out that, I'm trying to get back to here. There wasn't like that much salad oil in the world. There wasn't $300 million of salad oil in the whole world. And it was just an elaborate scheme to overstate their inventories. And they had all these fake sales they were reporting. So it was a huge fraud. All right. Last slide. Just remember, don't go down that slippery slide. And we'll see you all on Thursday.